Hey everyone, welcome back to my channel, where my mission is to help you become financially smarter every week. Today we dive deep into Ford's recent balance sheet, learning what it tells us about the company's financial health, risks, and opportunities. We'll also look at some examples and walk through Ford's key balance sheet line items. And along the way, you'll discover how to assess any company's balance sheet like an investment pro. So whether you're a shareholder, potential investor, or just someone interested in business, this is the video for you. Let's jump right in. So why does the balance sheet matter? It's a snapshot of a company's financial health at a specific point in time. It shows what the company owns, what it owes, and the owner's stake in the company, revealing its solvency, liquidity, and financial stability. The balance sheet reflects the accounting equation. Assets equals liabilities plus equity. Assets represent what a company owns, such as cash, inventory, buildings, and equipment, which are expected to provide future economic benefits. How well these assets are managed is a key part of analyzing the balance sheet. Here's a quick overview of the key components. First, there's current assets, which are expected to be converted to cash within 1 year. They include cash and equivalents, marketable securities, accounts receivable, and inventory. All these items contribute to a company's liquidity. Current assets are important because they show a company's ability to pay off its short-term debts. Next, there are non-current assets that have a longer time horizon, such as property, plant, and equipment. Intangible assets and long-term investments. These assets are crucial for understanding a company's long-term prospects. On the flip side, the liability section shows what a company owes, including both current and non-current debts. It's important to analyze the types and levels of debt to gauge a company's financial risk. Finally, the right side of the balance sheet represents the owner's stake in the company, also known as equity. Equity includes items like common stock, additional paid-in capital, and retained earnings. Changes in equity over time can provide insights into a company's profitability and dividend policies. In the next section, we'll go through Ford's balance sheet line items and discuss some of the unique considerations for their business. But before we do that, let's talk about 2 essential concepts you need to master to truly understand any balance sheet. First, there's liquidity, which measures a company's ability to meet its short-term financial obligations. A company's liquidity position can be assessed using various ratios, such as the current ratio and quick ratio. Second, solvency refers to a company's ability to meet its long-term debt obligations. Understanding a company's solvency involves examining metrics like the debt-to-equity ratio and debt-to-assets ratio. Together, these 2 concepts paint a comprehensive picture of a company's financial health. Now let us take a closer look at Ford's balance sheet for the first quarter of 2025 compared to the fourth quarter of 2024. Highlighting key trends and considerations. Starting with the assets side, we see a slight decrease in total assets from $133.6 billion to $133.5 billion. Cash and cash equivalents saw a notable increase from $16.2 billion to $20.9 billion, likely reflecting the company's efforts to maintain a healthy liquidity position. Ford's marketable securities also increased from $10.4 billion to $14.4 billion, suggesting the company is holding a larger portion of its assets in liquid, near-cash investments. Accounts receivable rose from $15.5 billion to $17.2 billion, possibly indicating growth in the company's credit sales. However, it's crucial to monitor this closely, as rapid increases can signal slower sales and collections. Inventory levels jumped from $15.0 billion to $17.9 billion, primarily driven by Ford's ICE vehicle business. This surge warrants attention, as inventory buildup can strain cash flow and raise concerns about demand. Moving on to liabilities, total liabilities showed a slight decrease from $108.9 billion to $108.7 billion. Current liabilities also dipped from $53.9 billion to $52.7 billion. The most significant components here are accounts payable, which increased from $24.9 billion to $26.3 billion. This rise aligns with the surge in inventory, suggesting normal growth in payables related to increased purchases. Ford's short-term debt also rose from $10.5 billion to $14.3 billion, largely due to a $6.8 billion loan used to refinance commercial paper notes. This change doesn't necessarily indicate a problem, as long as Ford can manage its debt obligations. In the long term, non-current liabilities remained relatively stable, totaling $50 billion. Long-term debt stands at $16.6 billion, while deferred tax liabilities,